we get it or not? Do we need it, a rate cut today for this economy?
No, we don't think so. From an investment strategy standpoint, our economics team continues to believe that we're going to see at least 2 cuts before the end of the year. I think what's going to end up happening, and we've said this a few times, is that we really believe that 2019 is this generation's 1995. I don't believe that we're going to see 3 rate cuts like we saw in 1995, Sarah, but I do believe the Fed misstepped in December when global growth was slowing and they raised interest rates. They came out in January and basically did a pivot, just like they did in early 1995 when Greenspan admitted that they cranked up interest rates too much in 1994. I believe that this is year 1 of at least 2 to 3 of Goldilocks, and I think investors have it wrong. I think investors have it wrong. As I've traveled around the world, and especially the last 4 to 6 weeks, those investors with less than 10 years experience really believe that we're going to see 50 basis points. And clearly the Fed funds futures is telling you that we're going to see 75 basis points still. But I just don't think that's going to end up happening. And I think the Fed will cut by 25. The market will probably bounce a little bit. But I think that in the long run, meaning the next couple of days as momentum starts to unwind, I think there's a very good chance the market sells off.
Well, that's interesting from you, Brian, because every time you're on, you always say buy, buy, buy. So are you talking about just a near-term kind of disappointment, or are you totally changing your sort of outlook here?
No. This is not changing. We still believe that U.S. stocks are in a 20 to 25-year bull market. The momentum trade has been all over the place, especially the last couple of weeks. Investors, we think, have it wrong in terms of wanting more from the Fed. We believe on a short-term basis there's a likelihood that they will be disappointed. We get a pullback and a pause. This market needs to pull back and slow down a little bit anywhere. Near term, Sarah, longer term, we remain excessively bullish on U.S. stocks.
Okay, just checking.
Yeah, interesting. I mean, from a stock owner's perspective, you better hope it's 25 because a year after a 50 cut is usually not good.
An initial 50 cut. That's right. I mean, and that's the thing. You basically have 4 precedents right here that you're working off of, the last 4 ones. You never did just get 1 cut. When you started with 50, of course, from much higher rates, it was basically a recession was in train. So obviously that's what you're hoping for. I mean, I think they can properly characterize this as an insurance cut. Now, there is a concept called overinsurance, right? You could be overinsured. But what's the cost of taking out this insurance? Is it really excessive? Probably not. 25 basis points and watch. I don't oppose the idea that the market has roughly priced this scenario in.
Well, the cost is that the market wants more, and it's going to fiend for more, and financial conditions are going to tighten unless the Fed gives it more.
More after the 25? Possibly. And then you could ease from tighter conditions, and, you're on that treadmill again, possibly. But 2% Fed funds rate is not crazy given where the rest of the world is. 2%, even 1 3/4 is not crazy. That's what's changed since December. Nothing has changed in U.S. policy except words.
Brian, core PCE, 3-month annualized. I mean, not to get too granular here, but it's running 2.5, a 7-year high. We got employment costs up 2.7 today. I mean, how likely is it that in 6 months a cut looks silly? We get a true rebound in at least employment inflation.
It's a great point, Carl. We remain excessively strong in terms of what's happened in employment. We are very, very lean and mean across all sectors of the market. In 6 months, we could have a situation where the China issue has passed, where we start to see the semblance of CapEx coming into 2020. I think 2020 is going to be more of a volatile year, especially considering the election and all the noise and rhetoric surrounding that. But you're exactly right. In 6 months from now, we'd be looking back saying we didn't even need that 25 basis point cut. But this, at the end of the day, Carl, this is still all about earnings, and forecasts still are looking for a rebound in earnings, especially in the fourth quarter. Going back to what Mr. Santoli said, you got to go back and look at interest rate scenarios when we're not heading into recession, like 1987, 1995, and 1998. The periods of the Fed cutting interest rates were very short, and the stock market was very strong, especially coming out of the rebound in 87 and then again in 1995. So that would be kind of the scenario that we would be looking for.
Yeah, 95, 98, 3 cuts over a few months, and that actually did help the economy manage to avoid a downturn.
It did. Now, 98, I mean, financial conditions globally had really tightened. The stock market did have a quick 20% drop, similar to what we had last fourth quarter. 95 is the dream scenario that everybody would want to point to because stocks were at a high at the time of the cut. The cut really did seem well-timed. It was a fine-tuning of economic growth because you did have a real domestic slowdown that averted a recession. Of course, I mean, the pushback on that is arguably you're at a earlier part of that economic cycle, and there was a lot more behind it, a lot more to run.
Quick, Brian, your favorite sectors with your excessively bullish call on long-term U.S. stocks.
I would say financials remain an area that we believe investors are massively underexposed. We still love technology. We still love communication services. I think healthcare, from a valuation and earnings basis in terms of growth at a reasonable price, is the sector for the next 6 months.